Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management e-News. Thanks for joining us. So today we thought we'd talk about what we've experienced the last month and a half, what we think about 2023, and we want to mentally prepare you for what we think is ahead. So we, like the rest of you, enjoy looking at our accounts and seeing that they've risen in value quite significantly over the last month and a half, and thinking maybe the worst is behind us. We don't think that's true. We think that the market was down at the worst point. The S&P 500 was down 25% from its peak last year, ended the year down about 20%, and we've rallied off that. Some of the parts of our portfolios, like international, developed international, are up quite a bit the last 3 months, but we still think there is volatility ahead of us. We wholeheartedly believe that we have to take the Federal Reserve's word, and what the Federal Reserve is saying is that they're going to continue to raise interest rates till they tame inflation. The market, on the other hand, doesn't believe them that they'll keep raising rates. The market thinks that the rates are going to start getting cut sometime next fall. We're not in the camp where that we think that's going to be true. We, like I said, have to believe what the Fed is saying to us, and that they're going to continue to raise rates. They're putting lots of the Fed governors out there on television to reiterate that they're going to keep raising rates to deal with inflation. And one of the things that historically has always happened is to deal with higher inflation levels, the U.S. economy has sort of had to go through a recession, which has tamed inflation for good. And we think that probably the same thing is going to happen here. Markets don't believe that. That's why markets are trading higher. Why I'm telling you this is that we want to mentally prepare all of you for volatility in the year ahead. So this market looks a lot like the late 90s, early 2000s market. If you remember, in the late 90s, we had a huge run-up for tech, telecom, media. Stocks were way overvalued. In March of 2020, after the Fed had raised rates 6 times, the market finally rolled over. And it was really 24 months later that the market finally found a bottom. And so, but within that 24-month period, we had lots of rallies, bear market rallies. And so all bear markets have rallies within them, and we think that's what we're experiencing right now. And we want to mentally prepare you for volatility in 2023 to the downside. Now, the reason we're not doing anything dramatic with your money, like getting out of the market, is because we could obviously be wrong, and the worst could be behind us. The answer to that is we don't know what's going to happen in the short term. We just know that we want to own stocks for the long term, especially if we have higher rates. So mentally prepare yourself for volatility in 2023.
Perhaps one of the most unanticipated outcomes of the pandemic is this legacy and the end of ultra low interest rates. And we're now at an inflection point where rates are going to be structurally higher for conceivably decades. When you look historically at interest rate cycles, they last and usually encapsulate entire careers. Interest rates peaked in the fall of 1981. They've been coming down ever since. 2022 will be the year that they reversed. And this Federal Reserve, Paul Volcker, is the spirit animal of Jay Powell, and he is taking to heart the lessons that Volcker enshrined in his book, Keeping at It, which was inflation came roaring back every time they cut rates historically, back in the late 1970s and early 1980s. And this time doesn't appear to be different. We're at the midst of a demographic inflection point. 10,000 retirees or 10,000 baby boomers leave the workforce every day. There's going to be about 3.5 million people exiting the labor force this year. My generation, 90 million of us, is having kids. We are leaving an age of oversupply, and what that means is rates are ultimately going to be higher for longer. The ramifications of this, as far as it relates to our clients' portfolios, are, of course, that's a good thing on the fixed income side. The bonds that we owned that last year paid 0.1%, over the next year are going to pay close to 4.7%, which that big piece of dead money that's existed in your portfolios is no longer going to be that. But the implications for stocks are sort of bifurcated. The high valuation stuff is going to suffer. And history has shown us that those multiples of that high valuation stuff, which we haven't allocated client money to, have declined for sometimes a decade going forward. That's not true for value stocks and small caps, which the equity risk premium, the compensation you get in stocks over risk-free, is actually higher. So your expected returns over the next 3, 5, 7 years, you should prepare yourself for higher returns over the long run. But in the very near term, it's sort of tough to see stocks really doing well because valuations were so high from the starting point. But we have to reconcile that. And most importantly, I think for our clients is the dividend reinvestment that's going to occur over this range-bound period is going to expand your share count pretty significantly. And so when stocks ultimately do climb because of higher earnings, the base that they're growing off is going to be a lot bigger, which should in turn reinforce your expectation of higher return over the medium and long run. Low interest rates borrow from the future. And so when interest rates are low, expected returns into the future should be correspondingly low. And we're exiting that regime, and we're not going to do it in 12 months. It's historically been a pretty bumpy period for 24 or 36 months, and we just want to prepare you for that.
Yeah, so remember, the good news is in a volatile market is that every quarter when all of your holdings pay a dividend, you're stacking up that share count. So when inevitably we start the next bull market, whenever that is, you have a much higher share count, and then we're off to the races. So remember, this is creative destruction is part of a capitalistic free market society. I know that's not been true for the last 15 years, but we feel like we're in that, we're going back to that. And so it's an important part of a capitalistic free market economy is this creative destruction where the businesses that should go out of business will go out of businesses, and the ones that should stay in business will do better. And so remember, every bear market sets the stage for the next bull market. When stocks go down, they get cheaper and less risky, and that's where we feel like we are right now. So as always, if you have questions about your situation or your account, call the office. The number here is 800-743-0988, or you can send either one of us an email. It's Josh or Tyler at northwestquadrantwealth.com. We'll see you back here in 2 weeks.